There's actually quite a few areas that we're avoiding, not necessarily because they're bad, but we don't think the risk reward is particularly attractive. So in capital markets broadly, we think the risk reward of having duration of any meaningful kind is dangerous. It's not dangerous in that you're going to lose all this money and the world's going to end. It's dangerous because you have very little, if any, upside. And if for some unknown reason inflation finally comes back, which is something people have been waiting for a long time and has not yet materialized, but could occur, and the Fed is forced to tighten policy faster than markets expect, you could suffer at least mild losses. So it's a classic case of like very little upside and at least mild downside. That's the base case, right? Another market that we think has at best poor risk reward is high yield bonds. So high yield bonds are the most speculative companies that issue debt, and they're not all going to default overnight by any means, but they have the highest likelihood of defaulting in the event of an economic contraction. So if you do get an economic problem, you're sure to have meaningful losses. Additionally, given where prices are today, which are very high, and spreads to risk-free assets, which are very low, you have interest rate risk. So you have risk from both an economic problem and from an increase in interest rates. And in the meanwhile, you're probably going to make 3 to 4%. So you're talking making 3 to 4%, which again is probably better than cash, of course, but you have very little upside. And if you get an economic problem or a big rise in interest rates, you could have meaningful downside. So that's an area of capital markets we're avoiding as well. Now, in terms of hedge fund strategies, we continue to think that CTAs or systematic trend followers are not a great place to be. A, because there's no bear market anytime soon, and that's the principal reason you own them. B, because investors invest in them or put their capital in them to be non-correlated to equity markets. The problem with that is their largest exposures are long equity markets. So, all right, equities go up, they make money, but you can get that elsewhere. If equities correct tomorrow or 6 months from now for any reason, they're going to take it on the chin. And in the meanwhile, other than equity markets, there aren't that many great trends out there for them to follow in currencies or rates. So we're avoiding that. We identified 3 areas that we're avoiding, not because they're going to end in tears and clients are going to lose or investors are going to lose a massive amount of capital, just because the amount of money you could make is not that attractive. And if you get a few things going wrong, you could have meaningful downside. And just to reiterate, that would be duration of any kind, high yield bonds, and in terms of hedge fund strategies, systematic trend followers, also known as CTAs.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.